Significance of Forex trading. Forex trading involves the exchange of different types of currencies for a profit. The reason for buying another country's currency may be the need to purchase some of that country's goods, as well as making money through the exchange rate gap. In the latter case, when the exchange rate is low, people buy a foreign country's currency and sell it off when the rates are rising. Trading in currency usually takes place between central banks, government, speculators, and MNCs. Without a foreign market, nations cannot trade with each other. In the Forex market, a huge amount of money is exchanged daily. Although the amount invested by an individual trader may be very small, no one individually, not even the government, can affect the Forex fluctuations. So it can be easily inferred that the currency level represents a country's economic strength or weakness. That makes the Forex market a good place to compete. The government and the central bank are trying to stabilize their country's currency by speculating, buying and selling currencies at the right times. But, if they carry out trade in huge volumes, they will control the market. Nevertheless, the government or the central bank must have large foreign currency reserves with them in order to buy their own currency. It is therefore virtually impossible to artificially inflate the currency value. Banks are trading heavily in foreign currencies, and this is a chunk of the Forex market volume. Not only as private entities, they buy currencies, but also on behalf of their clients. They are dealing in many futures. Trading volumes in the Forex market could be affected by the brokers up to a few years ago. But the broker services are not required due to the electronic services available now. It's easy to operate electronically. Only with the presence of Forex markets will trade with international countries. There is no common currency between the two countries when there is no Forex market. So one cannot determine the value of one currency against the other. The buyer pays the vendor in the currency of the former. The seller buys goods in the country of the buyer with the money so earned and sells those goods in his seller country. Only then can he realize how much he's gained by exporting. Nevertheless, in the presence of a Forex market, it is very convenient for a seller to learn at the very moment that he is performing an export trade about his earnings. Likewise, the buyer will also have a thorough knowledge of the cost of buying goods from a foreign country that he will have to pay. Keep learning. Keep earning. And I as always say practice. Practice. And practice. Best place to learn about stock market training. Technical analysis training. Price action trade. Fundamental analysis training. Options trading training. Forex trading training. Commodities trading training at NCFM Academy Hyderabad.in. Visit NCFM Academy Hyderabad number 406 Annapurna Block, Aditya Enclave, near Mitravanam, Amirpet, Hyderabad, India. Call +91 7702 486328 landline +9140 48560292.